Daily mortgage rates live with the mortgage calculator. We are going to go through some live rates today and then do a deep dive into short-term rental properties. We'll wait just a few minutes to get started though. Let us go live on all the different platforms and give everybody a chance to tune in here. I see some people were already tuning in. Thank you for being early. We put the chat up on the screen, so feel free to drop a comment in the chat as you come on here, and we will get started here shortly. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us a chance to go live on all the different platforms, and then we'll get started. Great topic for today, something that we really like here at the Mortgage Calculator. Thank you, everybody, for dropping comments. Adam, Joe, Julio. Thank you, everybody, for tuning in. Morning, Yakita, Warren, Melvin. Thank you, everybody, for tuning in, dropping comments. We'll get started here in just a moment. All right, looks like we are live on all the different platforms, so we can go ahead and get started. We can go ahead. All right. All right, looks like we're ready to go. Looks like I'm having some connection issues here. All right. I think I'm good to go. Okay, so welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. And what we do every day on this show, Daily Mortgage Rates Live, is go through actual live mortgage rates, pull up different programs, and then we do a deep dive into a different topic every day. Now, we at the Mortgage Calculator are a correspondent lender that specializes in non-QM loans. So our deep dive today is something we're very familiar with and that we specialize in here at the Mortgage Calculator, which is short-term rental properties. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to do a deep dive into the short-term rental investment property loans. So before we do that, though, we'll go ahead and pull up our pricing tool and go through all of the different rates today for a few different programs. So Nick, let's pull up the pricing tool and see what the market is looking like this morning.
All right. Let me switch my screen and we will check it out. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates and APR for today. It is July 25th, just after 11 a.m. Eastern. So we have our programs with some live rates now issued. If you'd like a full loan estimate with a breakdown of all the fees itemized that go into the APR, please reach out to our team members. We have over 300 loan officers, and we can offer loans in 24 states for primary and second homes, and we can do our DSCR business purpose loans in 44 states. So for all our demos today, we'll set up the same scenario in our pricer. We'll set up a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost. That's most requests that we get these days. We're going to check out our different loan programs. We'll start with conforming conventional as we do every day. Then we'll check out FHA, which is usually the next best option. And then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs that can use alternative income. We also have VA and USDA. Remember, VA is only for our eligible active and veterans. So if you are eligible, please let us know. We'd be happy to quote it. And same with USDA, that's only for properties that are eligible. So if you are shopping for a property in a USDA eligible area, let us know and we can quote that in a few minutes. So for the first example today, we're going to do conforming conventional purchase, 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with these general settings, let's check the rates this morning. All right. Touch up from yesterday. Hopefully we see the markets go back down just a touch as well later today. Best option this morning, 6.99 rate, 1 discount point in cost, puts our final APR just a touch over 7 at 7.157. So a good option here for our customers looking at conventional. Definitely a little better than it's been recently. Now, if our customers cannot qualify for any reason for conventional, usually the next best option to look at, we'll set up the same scenario, is an FHA program. FHA does allow a little more leniency on the credit type of issues, as well as a higher debt to income ratio. However, we'll keep it exactly the same so we can compare APRs across the program, apples to apples. So with the same exact settings, all we've edited is FHA. Let's check out the FHA rates this morning. So those went up a touch too, 6.5% rate for 0.75 discount points and cost. Puts our final APR just a touch over 7 at 7.084. So the other day, FHA was a little bit better deal, but it's still just a touch better deal in this case for this borrower if they qualify for both. So definitely recommend our borrowers that are out there shopping look at both options. For those borrowers that need to use an FHA option, the recent changes to the mortgage insurance is definitely welcomed, and it has made these programs even better for our borrowers that need to use them. So great options here. Now, where we really love to specialize at the Mortgage Calculator is if a borrower doesn't qualify for either conventional or FHA. Many other banks or lenders don't have other options, but that's where we specialize with our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs. So if we set up the same exact scenario and we select non-QM, we get a new option that pops up where we can use a different income. So full doc is what we use for FHA and conventional. That's 2 years of tax returns typically. So we will usually choose a non-QM option to choose an alternative such as asset related, business bank statements, our investor programs we'll talk about in a minute that we use for our investment properties. Our personal bank statement 12-month is the most popular. That's the demo we'll do today. We have RSU stated, VOE, 1099, P&L, and CDFI no ratio as well. So for the demo, though, we always select our most popular, which is personal bank statement 12-month. And that's for our self-employed borrowers. Many times our self-employed borrowers, when they have 2 years of tax returns, have maybe different write-offs and maybe have issues qualifying at all, or maybe can't quite get the income they need in order to qualify for the house they really want. So in this case, we'll solve that problem by using no tax returns at all. We'll simply use their last 12 bank statements to determine a debt to income ratio of 40% in this example, using their cash in the bank, no tax returns involved. So most self-employed borrowers will qualify for double, triple, or even more on the income, and therefore can qualify where they needed to qualify with alternative. So let's check out the alternative income bank statement options. So the best option here at the top, 7.5 rate for 1.75 discount points and cost, a little more expensive there. And the final APR, 7.592. So the non-QM programs are always going to be a touch more expensive because we're getting more flexibility here. But notice how comparable they are. So our conventional was just 7.15, I believe. So here we have a non-QM option that's within a half a point in final APR to compare across the program. So very cool options that we have for our borrowers that need a little bit extra help. And if you scroll down here, you'll see we have a ton of different variations. Some of these may even allow credit events such as foreclosures and bankruptcies. So items that would put a borrower completely out of qualification for the conventional programs, we can also solve with these non-QM options. So lot of flexibility here. Please get with our team members. They'll find the best one for you. Now, for today's topic, obviously, we're going to be talking about investments. So, we love to work with investors. So, we do a couple live investment property demos as well. So, whether you're a first time investor or seasoned investors, we have some great options. For the demo here, we'll set up the same scenario 80% loan to value, 20% down payment for an investment property. And we'll compare our two options. We have conventional conforming options as well as our non-QM options. Remember, the government programs, FHA, VA, USDA, do not work for investment properties. So first we'll check out conforming. We will keep everything else exactly the same. The only difference here is investment property. So we will see what adjustments the conventional programs have when we change to investment. A touch higher than it was the other day here, 7.5 rate for 3.25 discount points and costs puts our final APR at 7.742. So these conventional programs have added loan level price adjustments, basically penalties for investment properties. So unfortunately, we can't find any options for one discount point. The best option the computer found was 3.25, which is quite a bit of money. So most investors would rather, in this example, deploy this $13,000 elsewhere. So that's where our non-QM options come in. So these are great options for our borrowers that qualify, but most investors don't mind going a little bit higher in rate to save on the discount points. So that's where we do our final demo here for an investment property, 80 LTV, and this time we'll choose our non-QM expanded guidelines. And the first thing we must select for non-QM is our income option. And the most popular for investment properties is going to be our DSCR program. That's because it doesn't actually require any income or employment from our borrower. We simply use the estimated rental income from the property we're purchasing in this demo in order to determine a DSCR debt service coverage ratio. So if the estimated rents can cover the PITIA of the mortgage, aka the property cash flows on a monthly basis, that's a ratio of 1.00 or higher. We even have options for properties that don't quite cash flow on a monthly basis, and that's a ratio of under 1.00. But for our demo today, we will set it to the max of 1.5 so we can see all the options pop up. And the final thing we need to select for a non-QM investment property is prepayment penalty. It is standard for 3 years for these programs. However, there are options for no prepayment penalty that will cost a little bit more and limit the amount of loan programs. And same with the 5-year options. There are options for 5 years to save our borrowers a little bit of money, but not all loan programs allow it. So we always choose 3 years for our demo. So with these basic settings, let's check the DSCR options today. So best DSCR option at the top, 8.125 rate, 0.725 discount points and costs, and a final APR of 8.182. So obviously the APR just a touch higher here, but remember DSCR, no income, no employment, and we've solved our problem for our investor here with the discount points. Instead of $13,000, this one is only $2,900. So our investor's happy as long as the property cash flows typically. So most of the time when we present a DSCR option to a conventional option, about 90% of investors will choose a DSCR for the flexibility. Not only can we do some cool things with the no income, no employment, but some of these programs, as we scroll down, usually a little bit higher options will allow short-term rental income for our investors doing short-term rentals. So tons of different options here for different variations of the DSCR, just like the bank statements. Please get with our team to find the best option for you. But it's a perfect segue into our topic for today, which is going to be how to do a short-term rental property. Specifically, some of these options that you see here will apply to using the short-term rental income. So let me go ahead and switch my screen and we'll get into Jose's topic for today, which is going to be our short-term rental property loans, aka Airbnb, VRBO, whatever you want to call it. A lot of different options, very popular request. I'd say probably our most popular request every day, multiple requests for these types of loans. So obviously it's a hot topic. So Jose will have some specific examples. You know, we love to go over our live rates on the DSCR product, which does apply to short-term rentals. That's the one product that will allow us to use short-term rental income. but there's a ton of other variations as well. So since we never get to do this live, this will be a perfect topic to go into detail. So Jose, if you're ready with some examples, let's check out the short-term rental options.
Good morning, everybody. Thank you for joining us, Daily Rates Live with the Mortgage Calculator. Great to be with you here this morning. Our DSCR program is a very flexible option. It does allow us to do many different things for our investors, right? So, one of the things that we love to do is we love to find out different solutions for our investors' financing needs that would allow them to meet their objective for a number of different things. So in this scenario here, we have investors that are looking to purchase a property that they're going to use for short-term rentals. Right now, the main thing to note here is that we don't necessarily have to categorize the property as a short-term rental. It really depends what the program calls for and which is the program option that we're doing. Now, as you all know, for long-term rent, when we're doing conventional loans, they are more restrictive in what needs to be provided as far as the property usage. Not necessarily the case for many of the options that we have that allow DSCR to be used to qualify the property. And that's where the magic happens because we don't necessarily have to provide leases. If it's a property that's being purchased, it's being purchased for the use that you're going to use it for, right? So we simply then use the guidelines and whatever the guidelines allow us to do, right? And some, they may, if it's a vacant property, the more favorable ones would just allow us to go with the 1007, and that's it. And in some cases, if the 1007 income may not be enough, then we are able to use either short-term rental revenue reports or which would be for a refi usually, but we are allowed to use them for purchases as well if the current owner has been using the property as a short-term rental, and if the current owner will provide the last 12 months revenue reports. That could be another option, which I have used that one on loans that I have originated, or the unicorn that everybody loves, AirDNA, using the AirDNA database to basically look for short-term rental comparables in the database using the same parameters you would use for finding long-term rental comparables in the MLS, the realtor database, right? Proximity, similar style, and the other factors that you would use to pick a comparable, and compare it to another property. So the AirDNA database and the short-term rental revenue reports do pose some challenges because not all of the program options use them the same. In most cases, there are LTV adjustments or LTV limitations when you are using AirDNA and short-term rental revenue reports, but not in every single case. I will be providing exciting examples where they do use that adjustment and examples where they don't. And that's really where the magic happens.
So just to recap, though, if just because AirDNA spits out a number doesn't mean we can use it necessarily, correct? It has to be supported by real comparables, just like a regular appraisal, correct?
Correct. I mean, the same parameters are going to be used. You can't be using comps, 10 miles away simply because you found one. If there isn't anything in proximity to the subject, it's going to be a hard battle to fight to have them included, because then what could be the issue? Either you don't have enough comps because there may not be enough properties in the area. So now you may be dealing with something that may be considered rural in nature when the comps are more than 3 miles away from each other. that does pose issues for the appraisal. And there are requirements on a lot of times with the appraisals for the different options that require closer proximity than X miles. And usually one of the numbers that usually gets thrown around is 3 miles. So obviously I would recommend everybody looking at the guidelines of whatever option they're considering, but keep that as a rule of thumb. If all your comps are 4, 5, 6 miles away, you're going to have an issue where they may now state that your property is rural in nature. So you better make sure then that that program option allows properties that are rural in nature. Some do, most do not.
And just be careful that AirDNA will always give you a number, just doesn't always mean we can use it. So I just want to make sure people know that before these exciting examples up.
All right. So first example I'm going to share here would be the best option, right? 15% down DSCR, right? That's like the unicorn everybody looks for because that's the maximum LTV, aka lowest down payment that you can have for a DSCR purchase. Now, the good thing about this program should I say the not good thing about this program is that it does impose an LTV adjustment if you use AirDNA or short-term rental data. You'd be looking at a 5% LTV adjustment, so the 85 would become 80. Right. But it's good because in some of the other examples, the 80 could become a 75. Likewise, if you were using this data. But for the property that does cash flow above a 1.0, this is a and their rates are also pretty good here. You're looking at your lowest cost option, excuse me, with a little bit of a lender credit at 10.375. And you're looking at the lowest rate option at 8.625. So again, this is 15% down when the property does cash flow based on the long-term rents, then you can use this program. So now our next example would be same scenario. We're using DSCR maximum or rate benefit here because this would be again for a property where the long-term rents cover the PITI to have at least your 1.0 DSCR, right? So this would be a 20% down option. So now you can analyze here the difference between the 15% down option and the 10% down and the 20% down option. Now, let me go back a minute just so you can put a little context here. Notice is 8.625 here is giving us a $1,600 credit, right? And then we look at here 8.625 costing us $14,749.
So it's quite expensive to go with the 15% down option.
Yes, and here's the kicker now. So roughly adding 1,600 to that, we're about 16,000 and change, right? Let's just round it up down to 16. And we're looking at a loan amount of 425. So that's almost 4%, right? Difference between one and the other. And the LTV difference is 5%. So, I mean, I don't know what I would do if I was in that situation. You know, you're paying extra money just to have 5% higher LTV, but then you're paying almost 4% extra in fees. So you're going to have a higher loan amount at a higher payment and not really much of a net benefit to your pocket. But typically that borrower who then would probably go with this program is, possibly going to go somewhere up here. It's going to have a property, the amazing cash flow property. He's looking to maximize his leverage. So they're probably going to go somewhere up in the middle or maybe a little bit higher in the rate to not have that extra high cost. Because if they were, then they would probably want to consider this side here, maybe an 8.5 or an 8.375 and get a great rate for a little bit of extra money. But for our example here is, again, this is a property that will cash flow where you don't need to use any of the extra juice to get you to qualify. So now we're going here to the magical ones, right? This is an option that has no LTV adjustment for a short-term rental purchase using AirDNA and or short-term rental data at an 80% LTV, right? Real good to note that. Now, rate is a little bit higher than the one we just saw at 80%, but you get the full pop of your LTV and you get to use the AirDNA or the short-term rental data for a purchase, and you get to use the short-term rental data for a refinance. You cannot use AirDNA for a refinance. That is for purchases only, because once you own the property, you are expected to have the data to substantiate what you need to do. So if you're going to refi and want to use short-term rental data, you would need at least 12 months worth of data for that property to be able to do so. So here you do note 8.625 giving you a $100 lender credit. So the rate is about 1% higher than our more favorable interest rate option. And you can buy it down to 8.625. But remember, the key to this option is no LTV adjustments. So you at the 80%, you're getting the full 80%. They're not going to give you a 5% LTV haircut because you are using short-term rental data or AirDNA. Now, this example I have because it does allow the AirDNA and the short-term rental data with no limitations. So now I have another example here. This one allows us to use short-term rental data only, not AirDNA, without an LTV adjustment. They do add a little bit of a twist to it, in that what they let you do is they let you use the short-term rental data to achieve up to 115, that's 115, 115% of the long-term rent as depicted by the 1007. So you'll have your 1007 from the appraisal. If it comes in at $1,000 a month, you can go up to $1,150 a month if you can substantiate it with short-term rental data from the revenue reports or the last 12 months bank statements showing those deposits. So the reason, obviously, for this option, when you can get by with the short-term rental revenue reports, is that the rate is lower, much lower. You're looking at 9% with a $100 lender credit, and you can buy it down all the way to 7.875. So that is much lower than this option that has 9.625 and 8.625. So almost, 0.75% lower in most cases for this option. So again, we custom tailor the option chosen for the specific needs of the borrower and or the limitations that the property may or may not have. That's why it's not like one size fits all. We do analyze every specific situation and do choose the best path for that loan. So now I want to give you here, last but not least, a refi option, cash out refi option here. So this again is at a 75% LTV, which is the max that is allowed. And this one is the option that does allow the use of both AirDNA or short-term rental data. So hence you'll note the rates are a little bit higher, but again, it is a cash out, but a little bit lower in the rate because we're at a 75% LTV, but still very good option. for your investor. Now, if it's a cash out, we're not going to use the AirDNA like I mentioned, but we would be able to use the short term rental data without any LTV adjustment to be able to attain the desired goal from the investors. So just note out there that for our DSCRs in general, 85% LTV for a purchase is the max LTV, and 75% LTV for a cash out refi is the max LTV, regardless of short term rental, AirDNA, or whatever. That's the max. So the fact that we can do it at a 75 and still have those special qualities is amazing.
All right. It looks like we have a couple of questions. If we want to bring those questions up on the screen, Nick. See here. So Patricia is asking, where do you get the potential rental income from? So this was actually when we were talking about DSCRs before short-term rental. So do you want to talk about the 1007, Jose?
Yes, yes. The market rent is established by the appraiser from a rental income report that they put together, where they just look for comparable rentals similar to the subject in proximity, distance, style, all those uh, characteristics that you would look for to have it be a suitable comparable. What we do have to note is that not every program option treats the 1007 in the same manner. Some options require you to strictly use the 1007. Other options let you use rental income that is being generated by the property if it's higher than the 1007, if you can show deposits for the last 3 months. And then in our short term rental twist to this, we would be showing the last 12 months of short term rental revenue reports, assuming that that particular option allowed it. Because again, what we're talking about now is not across the board allowed at all of the DSCR options. Only certain options allow the short term rental component. So just be aware of that when you are sizing up your deals.
So we're still going to get a regular appraisal. We're going to get a value, but then we're also going to order the 1007 market rent schedule, right? So we're going to have a appraisal value of the actual property and then the rental income.
Yes, well. And then depending what path we're taking for the loan, we may have on top of that either the AirDNA report or short-term rental revenue reports for the last 12 months that would be from the platforms where the property is being marketed, or would have to be 12 months bank deposits where we could see the deposits going into the borrower's account.
All right, so here's a great question, Nick. You want to answer this? This is one of the things that you love.
There is a limit technically, but yeah, it's pretty high. So most programs will allow up to 5, and some allow up to 10 by default. But like for example, we did 8 in one shot for an investor that was refinancing a portfolio of 8 properties, and the investor that's buying the loan, obviously the loan program investor, allowed 8 when they normally allow 5. So since we have about 30 different outlets for DSCR programs, about 28, 30, roughly about there, there's really no limit for you, Rob, as the borrower. But yes, us, when we're structuring these deals, at the end of the day, the same company that's holding your servicing, right, doesn't want to have more than typically 5 or 10 per investor, but we have dozens of other investors, so there's really no limit. We haven't really ran into that because we have so many outlets, and that's really what we specialize in here at the Mortgage Calculator, is having different programs, that's what it goes over, for different scenarios, right? We can't just have one type of DSCR program, as Jose went over, because every deal is different, especially with short-term rents. So we have dozens of different programs with different end investors that end up holding the loans. So you won't run into that issue there, Rob. we'll definitely, our end will solve that problem for you. So there really isn't a limit. Jose, you want to add anything?
No, that's it. What I would state is that it does vary from program option to program options, and they usually don't cap it at the number of properties. They cap it by total loan amount. So if you have $100,000 loans, you're gonna have a lot more properties than if you have 5 properties each with $1 million loan. You're probably gonna be at the limit because it's somewhere around there.
Mm-hmm. Yeah, there's a total limit and sometimes a loan limit. So another question for you, Jose, on the 1007.
Yeah, I touched briefly. I touched base on that when I was giving my other explanation. If the actual rental income received is more than the 1007, again, this really depends on which program option that you're looking at, because not every option has the same guidelines. Some strictly require you to go with the 1007 only, in which case, if your actual income is higher, there's nothing you would be able to do. Others do allow you to go with the actual income received if you can document it being received for at least the last 3 months. So you'd have to show deposits in your bank account. So for those investors that take the cash and use it and don't deposit it in the account to then pull it out, they may have an issue being able to document that higher rental amount.
So it must be documented. Even if it exists, we must be able to document it. All right, good questions.
Great questions. I don't see any more, so I think we'll go ahead and wrap it up. If you need more info on these programs, one of our 340 loan officers across the country can navigate you through it. You can visit us at themortgagecalculator.com, and we can pair you up with one of our loan officer consultants that can walk you through these different options. We do this show at 11 a.m. Eastern every weekday, where we go through the live rates and then do a deep dive into a different topic every day. So we'll have a different topic for tomorrow. So thank you, everybody, tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody.